This is the Asia Trade. I'm Shery in Seoul.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Asian stocks are facing a weaker open as Wall Street's rally stalls, a gauge of Chinese companies falling the most in 4 months. The dollar's losing streak sending G10 peers higher. Tesla suppliers in focus as the EU prepares to slap an additional 9% tariff on the company's China-made cars. And Barack Obama set to headline day 2 of the Democratic convention as Kamala Harris leans on his campaign team in the race for the White House.
And Heidi, of course, we are awaiting eco data all around this week, but one that we're watching very closely, preliminary revisions when it comes to U.S. jobs growth on Wednesday. Of course, it will have big implications for when monetary policy changes with the Fed. We are expecting, of course, a potential rate cut in September, but it's really that narrative around the labor market. The expectation right now is for a downward revision. Goldman Sachs indicating that it could be as large as 1 million. A downward revision to employment of more than 501,000 will be the largest in 15 years.
Yeah, and Wall Street is sort of still expecting this soft landing scenario when it comes to the US labour market on the basis of what has been a pretty robust, pace of monthly non-farm payrolls gains. But anything less than sort of 800,000 fewer jobs, what that sort of potentially means for the labour market, we could kind of look at factors including overstated job gains. They might still be present as well, some distortions in that data. So there's sort of some complexities potentially as we see this kind of moderating growth that we see in the labour market picture there.
So important not only for policymakers but for markets as well, right? The July jobs numbers from the U.S. really leading to that $6 trillion sell-off. But take a look at the setup right now across Asia because we've had some big gains across the board. Japan, for example, we saw gains in the previous session with the Japanese yen. Even though it's continued to strengthen, it's still underperforming major currencies, of course, especially when it comes to this decline against the U.S. dollar of about 4% this year. But we are awaiting, of course, BOJ Governor Kazuo Ueda also speaking in Parliament for a special session on Friday. And we do have trade numbers out today, so do watch out for that. We'll bring them to you live. And, of course, here in South Korea, it's a rainy day. The Kospi rose to the highest since the beginning of August. We will be watching the Korean won very closely as well because, of course, it's all about U.S. dollar weakness. Take a look at how futures are setting up right now because we had a fall of the S&P 500 for the first time in 9 sessions. We're now below the 5,600 level. Really not doing much in the future session right now, but the dollar is still at the levels that we haven't seen since March. So on the other side of that trade, we've had the Asia dollar index close to a 1-year high. Let's bring in Bloomberg opinion columnist John Authers joining us now to make sense of the market moves and also what else to watch, especially, John, as we continue to really discuss the labor markets and what sort of preliminary revisions we could get to U.S. jobs growth. How could this really impact how investors see where the Fed is going from here?
Well, at this point, unemployment appears possibly even to be more important to the Fed than inflation. It's one of the few central banks that is required to consider both inflation and unemployment. If there have been a number of very strange things about the unemployment data for a while, if you do find that this finally reconciles more to a picture that you're getting from the unemployment rate from the household survey, that it shows a much cooler labour market than people had thought, then obviously that gives people much more confidence that you'll get a 25 basis point cut. It might also drive or bring back hopes that there would be a 50 basis points cut in September. I think that still requires some pretty drastic revisions myself. I don't think the Fed wants to start that way, and it doesn't want to do something that dramatic close to an election.
John, when it comes to how we sort of characterize the state of the market at the moment, obviously risk is back. A number of these carry trades, not just the yen carry trade, are coming back. But how do you, I guess, explain what we're seeing across equity markets to perhaps what we're seeing with the US dollar and even levels that we have for precious metals like gold?
I think there's a unifying theme across those, which is that people are more nervous about US growth. And that ties into lower rates in the US. It means that differentials have narrowed or moved against the dollar, meaning that rate expectations are falling much faster in the States than they are in the Eurozone. And that creates a situation where the dollar is, gets much weaker and closed today, if you go by the broad DXY index, down for the year, for the first time all year that's been true. Now, providing unemployment stays under some kind of control in the US, and I've got no particular reason to say it won't, then that's still consistent with the kind of rebound we've had in the stock market. A weak dollar actually helps US stocks because it makes their foreign profits look bigger in dollar terms. If there is more fuel for a weaker dollar to come from really bad economic numbers in the US, then that becomes a much harder balancing act to maintain. But as it stands at the moment, people think the US is slowing down, and that translates into lower bond yields, a weaker dollar, and still no great disincentive to buying US stocks.
John, of course, we continue to watch the political theatre. This week it's coming out of Chicago with the DNC. And I do wonder, how are you gauging this from a market risk perspective, right? Because maybe, as you say, little suspense remains in terms of what we end this week with the presidential nominee. It still really matters.
Oh, it matters greatly. I think the thing that hasn't really affected the stock market yet at all, but could do if Kamala Harris's momentum actually does manage to continue for a few more weeks, is that a Democratic clean sweep had been regarded as more or less out of the question until a month ago, largely because the Democrats are defending a lot of Senate seats in pretty difficult states for them to hold on to: Arizona, Pennsylvania, Ohio, Michigan, etc. And at this point, very surprisingly, if you look at the polls, there does seem to be a shot that the Democrats could hold on to the Senate. And if that happens, and there's no whiff of that in the price at the moment, if that happens, then the possibility of quite a significant corporate tax rate hike becomes really quite real. Now, that I'm not going to get into the policy that they say could well be a good idea to try to close the deficit by raising corporate tax. Stocks would not like it, and it's not priced in at the moment. So I think that's the critical point for the next 2 months: is have the Democrats managed to strengthen themselves so much that they can hold on to the Senate?
A Bloomberg opinion columnist, John Authers there. And let's stick with the Democratic Convention. The former US President Barack Obama will take the stage on the second night of the convention in Chicago. Kamala Harris is already leaning heavily onto his former staff and strategy in her bid to win the White House. Political news director for Bloomberg TV and radio, Jody Schneider, joins us now from the thick of the action and the excitement in Chicago. So as the former President Obama takes the stage, he'll also be returning to the fray in champion in other ways, right, including some of his former team members.
Yeah, that's right. You can hear there's a lot of excitement already on the floor of the United Center here in Chicago. We will hear from a number of other people before we get to the keynote of the night, former President Barack Obama, who is certain to energize this place even more. We will hear from Senator Bernie Sanders, Senate Majority Leader Chuck Schumer, and some other lawmakers who will kind of introduce the evening. We'll also hear from the husband, the second gentleman, right now hoping to become the first gentleman. That's Doug Emhoff, the spouse of Vice President Kamala Harris, who will not be here tonight. She and the vice presidential nominee, Tim Walz, have made a visit to Milwaukee and they're actually speaking at where the convention was held for the Republicans a month ago. But there's a lot of excitement here. Last night, as you know, we heard from President Biden, who came, kind of gave a farewell address, basically threw his support to Kamala Harris, and then left, went on vacation. Now it's Kamala Harris's convention.
Yeah, I mean, that speech by President Biden, very, very emotional, really touching, hitting a chord with Americans as well. We're also hearing from Donald Trump making some noise in Michigan as well.
Yeah, Donald Trump is doing counter-programming this week. Often the person whose convention it's not doesn't do a lot, but Donald Trump is barnstorming. He's going to 4 different swing states, doing a number of interviews, doing campaign events. He's trying to make it clear that, he wants the stage. He doesn't want to give the attention to Kamala Harris this week. So we're going to see a lot of, this is even before the real kickoff of the campaign season is Labor Day. And they, of course, have a debate on September 10th in Philadelphia.
Jody Schneider there joining us from Chicago at the DNC, Bloomberg TV and radio political news director with a busy week ahead. Now, the European Union says it plans to introduce an additional 9% tariff on Teslas imported from China. It's the next step in the bloc's moves against Chinese-made EVs, which it claims unfairly benefit from state subsidies. China correspondent Mingmin Lo joins us now from Hong Kong. So what impact could this actually have on Tesla, Mingmin?
Well, the stock certainly doesn't like it. It was down 0.7% in the intraday, and it's down about 0.5% in the after hours, the last I checked. And this could have a huge impact on Tesla because it produces more than half of its electric vehicles from China. Shanghai has that gigafactory that is bigger than some of Tesla's other plants combined. And last month, Tesla had already hiked its Model 3 cars that are sold in Europe by about 1,500 euros, citing these additional tariffs. Tesla had asked the European officials to study its company separately from the other Chinese companies, citing that they receive less subsidies and so should get a lower tariff rate. And it looks like the EU officials agreed, giving them a tariff of 9%, which is less than half of what the average tariff is for the other producers, and less than 4 times the highest tariff rate of 36.3% that SAIC has to pay. And this comes as, the EU officials say that Tesla still receives certain levels of benefits from the Chinese government, including land use rights, income tax reduction, various kinds of grants, as well as the provision of batteries that are below market rate, and also the national subsidy that is applied to all exporting producers. The good news is that given this uneven tariffs that is applied across the board to different EV makers, Tesla will have a big competitive cost advantage here, given that they are paying a lot less tariffs.
What sort of response could we see from Beijing?
Yeah, Beijing has been quite angered by this. We already have seen, months of talks leading up to this point. Beijing had already opened up probes into European brandy and European pork. They have threatened to retaliate in other sectors as well, including agricultural products, aviation, for instance, and even vehicles with large engines. Beijing sees this as a form of protectionist move, and the Chinese Chamber of Commerce has also hit out at the EU, saying that there is no evidence that the Chinese producers are making a material injury to the EU market. But meanwhile, the Chinese producers are already making contingency plans, with many producers looking to invest in plants in Europe to bypass these tariffs. BYD, for instance, looking to open up a plant in Hungary. Chery, which is another Chinese automaker, looking to open up a plant maybe in Spain. And this could maybe go some ways to help assuage some of those fears about Chinese producers undercutting their European counterparts and taking away European jobs. So these plans could bring in more investments to Europe, bring in, more jobs, paying European wages to European workers. There is still some time for negotiations to go ahead up until the end of October, when the definitive rates for the tariffs will be imposed in November.
Bloomberg's China correspondent Min Min Lo there with the latest. Well, coming up on the Asia trade, Goldman Sachs giving us their outlook when it comes to the EV battery market, what it means for global energy transition efforts. We'll also be talking market strategy. UBS Global Wealth Management and Natixis will be along with us as traders await those US jobs revision numbers and the meetings of the Fed, minutes, I should say, of the Fed meeting. This is Bloomberg.
Bloomberg is live at the Jackson Hole Economic Symposium, bringing you news and interviews with Fed leaders and other economic experts. Tune in for continuing coverage leading up to a special episode of Surveillance August 23rd at 9 a.m.
It's a rainy day here in Seoul. It could be a little bit grim when it comes to the stock markets across Asia as well. We're seeing some downside to futures trading at the moment. Of course, we had U.S. stocks falling for the first time in 9 sessions. The S&P 500 below that 5,600 level. Of course, we had those gains in the Japanese market, not to mention the Korean market, with the Kospi rising to the highest level since August 2nd. It was really led higher by chip and financial stocks, but we are seeing those tech stocks also taking a hit in the U.S. session. Our next guest says the sell-off in the tech sector is a buying opportunity. He joins us now here in Seoul. Jung Yoon, founder and CEO at Fibonacci Asset Management Global. Great to see you here. Thank you so much for coming in despite the rain.
Thank you. It's my pleasure.
So let's talk a little bit about those tech stocks because you are still optimistic. Do you think the valuations might have gotten a little bit stretched, or are we better now that we actually saw that correction?
Well, before the correction in the early August, it was a little bit high. If you look at the P ratio, it was nearly 40. Now, after sell-off, it's more reasonable level. I think because of the recovery demand in China and strong, robust demand from U.S., the tech sector can have the more room to rally toward the first quarter this year.
What does that mean for Asian stocks, especially those veered towards tech, but also towards that potential in AI?
So there are 2 ways to trade techs. You can buy techs directly, but you can also invest in sectors that will benefit from the AI rally. And one of the 2 sectors we are looking at is electricity and liquefied natural gas, as the demand for electricity will heighten up. And our current infrastructure for electricity for AI rally is not adequate.
How have they done so far?
If you look at the stock like HD Hyundai Electrics or RS Electrics, despite the sell-off, it recovered very quickly and reaching all-time high pretty much very soon. So if you look at the first half of this year, the stock price already up by more than 50%. But we think it's still undervalued and has more room to rally.
When it comes to broader volatility, it feels sort of eerily quiet, but you can see by what's being expressed in gold, in the dollar, for example, there's still some caution out there, right? Do you worry about currency volatility and yen moves and what we could see kind of being a repeat of the market moves that we saw just a couple of weeks ago?
So, yes, we've been advising our clients to raise the cash level for some time, because the volatility can revisit more often than expected. We saw some fundamental weakness in the current market where the false alarm in the health of U.S. economy combined with the unwind of yen carry trade knocked off one of the largest equities market in the world. So we've been advising our clients to hold some liquidity because there'll be lots of volatility coming in, but each time we see a sell-off is a buying opportunity. So we would like to buy the dip.
Are there international assets that might be good leverage in terms of almost serving as safe havens? China could be an interesting one. We know that a lot of strategists have also really doubled down on India as well.
So China's been seeing some sign of weakness. In the first half, we saw a little bit of rally pushing up the value of the stock. However, it quickly evaporated. And what we are seeing now is that Chinese policymakers are pushing to drive and create a semi-quantitative easing, sort of. They're seeing more yields coming in and more demands coming in. It's a treasury market. So if you look at from the Chinese policymakers' perspective, now is right time to issue more bonds and intervene in the market, and they can do that now.
We've been talking a lot about geopolitical risk and, markets have a real tendency to sort of downplay that, right? Are you keeping that sort of in the back pocket as a risk as we head into November, not to mention some of the broader sort of global risks? Or is that something that you think, these investors are sort of largely immune to as they focus more on earnings fundamentals in each market?
I think the geopolitical risk will continue, and it's not just Europe, right? It's also Middle East and other parts of Asia as well. There are ways to ride in this geopolitical risk. If you look at the defense stock like LIG Next One, Hanwha Aerospace, or Hyundai Rotem, it's been making a killing export due to increased demand for the missiles and tanks. Those are important aspects that we are looking at, and I think one of the good way to hedge the geopolitical risk is to increase exposure in these defense stocks.
Of course, defense stocks are also very important when it comes to South Korea, given the presence of North Korea. We are expecting the Bank of Korea's rate decision this week. It seems to be a non-event. It seems that rate cut might potentially have been pushed. What will you be watching?
So if we are looking at the FX rate, we see some weakness in the Korean won recently. And that's mainly due to a concern that if BOK cut rate tomorrow, but not followed by U.S. Federal Reserve, then the gap between the interest rates will weaken the currency. So foreigners were selling in Korea. However, from BOK's perspective, there's no rush to cut rate tomorrow. If you look at the FX, there's been stable increase in the export, and for the 9 consecutive months, we've seen the net export increase in Korea, and that trend is not likely to change. Also, if you look at the real estate segment, there's a very high chance that real estate segment will hit the bottom second half of this year due to the decreasing supply of new construction and stabilization of the construction price. So even without BOK's intervention, there will be no contagion in the banking sector. So overall, BOK is not in a hurry, and I think tomorrow we will not see rate cut from Korea.
Yeah, we also saw the Financial Services Commission overnight tightening the mortgage loan limit for those homes because of the real estate market. Jung In, great to have you with us in this rainy day here in Seoul. Jung In is the founder and CEO at Fibonacci Asset Management Global. We have more ahead on the Asia Trade. This is Bloomberg.
Everyone is looking for a way to get into the bond market and frustrated beyond belief because they never got to buy at yields of 5 to 6%. And once rates start coming down and money market fund returns start to drift lower, that money will come in.
JP Morgan Asset Management Global Head of Fixed Income, Bob Michel there. Let's take a look at what we're watching when it comes to global bonds. Of course, the fixation really being on the labour market data expected from the US as well as those Fed minutes as well. Given the expectations of that quite significant revision when it comes to the jobs numbers, we've also heard a little bit more from the Fed as well. Federal Reserve Governor Michelle Bowman saying that she still sees upside risks to inflation, but will support rate cuts if inflation continues to come down. This is a picture when it comes to treasuries as well, as we expect to see this Asian session really be dominated by that decline in equities trading. This is Bloomberg.
Take a look at how currencies are trading after the dollar continues to linger around those lows that we haven't seen since March. Of course, we're very much following what the Chinese yuan is doing as well. I mean, it's been really trading within a range this month after surging to that 14-month high against the US dollar earlier in August. It's still down for the entire year. But the reason that we're watching the yuan very closely, what happens if we get that unwind as it happened with the Japanese yen? What happens to the Chinese yuan? Also, the fact that China's FX regulator is apparently gauging the impact of a stronger yuan on exporters, according to people that Bloomberg has spoken to. We'll also be watching automakers in Hong Kong and Shanghai later. The EU now advancing its investigation into China-made EVs as we await key earnings. Let's get more with our tech reporter Annabelle Drewler. And Geely, one of the names at risk of extra tariffs, and it reports today.
Yeah, that's right. It is certainly one of the risks to the outlook for Geely. And today in the earnings, what we're going to be perhaps most paying attention to is comments or any sort of comments we get from its subsidiary Zeekr, because it could be looking to build EVs in the EU to try and avoid tariffs there. Ultimately, though, it's shaped up to be quite a strong first half for Geely. Actually, our Bloomberg intelligence team is saying we're likely to see a jump in earnings. It's going to have meant more shipments, more exports, a better product mix. They're all things that are positive here. What is perhaps one of the key risks to the outlook, again, that's being highlighted by our Bloomberg intelligence team, is that intense price competition war in China, where you've just got perhaps a couple of dozen that could expect to be profitable just in the next few years, when you've got around 140 automakers that are in the mix.
Another automaker feeling that price war impact is XPeng. What did we see from those numbers?
Yeah, not great numbers from XPeng when it reported overnight. What we had in the second quarter was actually a net loss, still a bit narrower than expected, but where we really saw investors paying attention and analysts was what it guided for the outlook. This chart here taking a look at revenue guidance, you can see at the high end, but materially below estimates. That's the line in yellow, or those bars in yellow at the top. At the bottom, you're looking at losses, and really what's so far been an absence of a path to profitability for the automaker. So we had deliveries, for instance, those projections for the current quarter. They are expected to beat estimates, but projected revenue from that is well below what Wall Street had been expecting. So basically, they're not making as much money as hoped per car. And again, that speaks not only to the weaker macro environment in China, but also just to that intense competition and the new entrants that are coming into the space.
Yeah, I mean, let's talk about Xiaomi, because everybody seems to be in the EV market now. You would think it's a smartphone maker, but it's also now in this space.
Yeah, Xiaomi's proving perhaps it's capable of doing both, because, again, actually becoming or getting into the EV space could have been something that really helped Xiaomi in its latest numbers. What we're expecting for it to report later today is perhaps its fastest pace of revenue growth in 3 years. We're expecting a near 30% jump in revenue for the June quarter. The estimate for around 87 billion yuan, around 47 billion of that is going to come from the smartphone business. But still, we're expecting to see that the sales from its EVs could start to kick in. So yes, something that, as we say, could be helping Xiaomi. Certainly doesn't help its competitors in the space, the likes of XPeng, for instance, that's really feeling the heat from this increased competition.
Yeah, still getting my head around Xiaomi being a EV maker now. Annabelle Drewler's there in Hong Kong with a roundup there. But broadly, the slowing growth rate when it comes to EV sales has put battery makers in a tough spot, leading to lower than expected volumes, intense competition, price cuts to defend market share. But despite that, the outlook has been offset by the booming stationary storage market. Joining us now is Nikhil Bhandar, who's a co-head of APAC Natural Resources and Clean Energy Research at Goldman Sachs. Nikhil, really great to have you with us. So there's a lot of sort of confluences of factors at the moment, right? And I guess going back to, what Annabelle was focusing on in terms of the dynamics of the Chinese market, you are kind of seeing the dual pressures of both a slowing domestic economy and increasing geopolitical pressures on overcapacity from an external demand side. But I believe your house view is actually still quite constructive on the Chinese battery makers.
Yeah, sure. Firstly, thank you for having me on the show. Look, I think there are a couple of points as it comes to China's battery market. Firstly, on the demand side, we are estimating China's battery demand to grow still nearly 30% this year. This is driven by a more stable growth in the EV sales market compared to the ex-China market, where the growth has been much slower. In China market, there is a faster translation of the falling battery raw material prices into the EV prices. And the EV sales growth has been rather more stable in China. But also, as you mentioned, there is also a booming energy storage demand market where demand this year has grown in the first half, estimated about 120% year on year. So demand's still okay in China and growing at nearly 30%. The bigger debate has been the overcapacity. The good news there is the capex for the battery manufacturers has been falling rapidly in the last few quarters. Our team estimates nearly 30% of the battery manufacturing capacity in China is operating at cash or below cash break-even levels at the start of this year. What's that doing is the capex for these battery manufacturing industry, in our view, peaked at in fourth quarter of 2022, and since then has declined by nearly 50% in the most recent quarter. So you have capex declining, but demand still growing 30%. So even amid a slowing market in the ex-China for Chinese manufacturers, we see a line of sight for battery plant utilization rates to gradually recover in the next couple of years, which should be supportive for their gross profit margins.
So sort of your base case scenario is to see this sort of soft landing through the current down cycle, right? ZATL is the top pick. Is that sort of the most safety that you would see? And potentially, could you see more consolidation with some of the other players?
Sure. So I'll not go into the specifics of each stocks, but again, I'll highlight the important theme here. The important theme here is to stick to the cost curve leaders. China battery industry in general has been putting out the most R&D for the battery industry globally in the last 2 to 3 years. And within that, the leading companies have been much more differentiated on the cost curve. There is a big gap in the cost curve between the top tier maker and the tier 2 and tier 3 makers. So clearly, the profit margins are more supported for the top tier category. And that's going to be an important theme as we think about the investment ideas in the China's battery industry.
When it comes to cheaper EVs, we heard from Elon Musk that potentially he could bring more affordable cars next year. Is that sort of the break-even point when we're getting EVs really catching up with the prices in combustion engines?
Sure. So clearly, when you look at the ex-China market, the dynamics have been different. There's been a speed bump outside China, where the battery demand has come down materially on a growth perspective. We do think this downturn is more cyclical in nature. Battery prices are falling rapidly, and ultimately, we do think that will boost the EV demand. We are expecting about 23% reduction in battery prices this year globally, and another 20% reduction towards battery pack price of $90 per kilowatt hour by next year. Now, I want to emphasize there is some delay in translation of lower battery raw material prices to lower EV car prices outside China. And as such, when we account for that delay, 2024 economics of EVs is not attractive. However, there are catalysts opening up into 2025. Firstly, as you mentioned to your question about economics, we do believe the economics of EVs versus internal combustion engine cars without subsidies could arrive between 2025 and 26 for the U.S. market. So again, that should be supporting. So the launch pipeline next year will be reflecting the declining battery prices, and that should improve the economics of EVs. But the second driver for demand recovery next year will be still some regulatory tailwinds in place. In U.S., of course, implementation of the Inflation Reduction Act is the key, but also in the European market, the carbon rules require auto industry to cut CO2 per kilometer further, and that should also boost the EV mix in the European market next year.
And Nikhil, how do you really quantify the tit for tat when it comes to the tariffs and geopolitical tensions and just the subsidy wars that are happening between regions right now?
I think the dynamics are different when you look at the U.S. market versus the European market. In the U.S. market, the debate is more about when will the TAM recover, the growth in the addressable market, where, again, we are arguing with regulatory support, 2025 itself will be a key year. But without also, we think 2025 and 26, somewhere in between, the total cost of ownership will become attractive. So again, the debate in U.S. is more about when the TAM will recover rather than who takes the TAM, because the tariffs has made the ex-China battery makers more competitive in the U.S. market. both because of the import tariffs on batteries, but at the same time, the local producers get large advanced manufacturing tax credits. When you combine the two, the cost positioning of ex-China makers is more attractive in the U.S. market. However, when we look at the European market, we're less worried about the TAM recovery because there is a regulatory mechanism in place next year of the CO2 per kilometer rules. The debate there is who takes the TAM, because the landed prices of Chinese batteries are a lot more competitive in the European market than the batteries made in the Europe currently. So again, Europe is going to be a more competitive market where you've got Korean battery makers operating there. You've got China importing as one of the options. China is also onshoring batteries in the European market. And the local manufacturers in Europe are also starting to take off. So in Europe, the debate is less about when the TAM will recover, but more about who takes the TAM. And we believe the market will be more divided between China and the ex-China players in the European industry.
Nikhil Bhandar, co-head of APAC Natural Resources and Clean Energy Research at Goldman Sachs. Really great to have you with us. Let's take a look at some of the corporate headlines that we're following today. And Bloomberg has learned that HSBC is exploring a sale of its South African businesses as the lender focuses on Asian markets. Sources say the South African branch business and securities unit have drawn interest from bidders in the region as well as China and the UAE. HSBC is seeking ways to cut costs and complexity under its new CEO, Georges Eldery. Analysts say Couche-Tard's bid for 7-Eleven operator 7&I will take a great deal of financial wrangling to accomplish. TD Cowen says Couche-Tard will need to raise as much as $18 billion of equity to keep leverage down and cover the potential deal price. Raymond James analysts say the Canadian firm may need to pursue a US listing to access equity financing. Eli Lilly shares jumped in New York as a long-term study found patients taking its weight loss shot, Zepbound, were 94% less likely to develop diabetes. The 3-year study followed more than 1,000 patients with obesity and pre-diabetes. Those taking the highest dosage also lost almost a quarter of their body weight. More ahead on the Asia trade. This is Bloomberg. Australia's window for achieving its goal of net zero carbon emissions by 2050 is rapidly closing. Bloomberg NEF's latest report says Canberra needs to channel $2.4 trillion into the energy system over the next 25 years to be able to hit that target. Bloomberg NEF senior associate Sahaj Sood is here with more. So how are we tracking? Could it still hit net zero in time? And of course, the sort of political circumstances can make this very challenging.
Yeah, definitely. So the research that you cite is from our New Energy Outlook Australia report. It's a report that we put out about once a year, in which at its core is basically a scenario analysis in which we look at the possible pathways that Australia can take to hit net zero by 2050. Now, one of the main ways that Australia can do this, the single biggest contributor to Australia's emissions reductions, is by switching from fossil fuel power generation towards more clean power sources like solar and wind. This accounts for about 54% of Australia's emissions reductions over the next 25 years or so. But it's not just clean power, it's also things like electrification of end-use applications. So increasingly adopting electric vehicles as opposed to ICE, internal combustion engine vehicles, will become important too. This accounts for about 20% of emissions reductions. But there's also a whole suite of new technologies that might not be commercially viable today that would have to scale up by 2050 for Australia to hit net zero. So for example, these would be things like carbon capture and storage. It's essentially attaching this technology to facilities that emit carbon dioxide but stops it from reaching the atmosphere, sequesters the carbon dioxide before it causes any harm. This accounts for maybe about 7%. And then there's also hydrogen, which there's a lot of hype for in Australia, another 4% of emissions reductions by 2050. So it's a whole suite of new technologies that would have to get us there.
Sort of the majority of that clean power is obviously going to be accounting for the bulk of the emissions abatement. Is enough being done? How much needs to be done to close the gap?
Yeah, sure. So today in Australia, there's about 45 gigawatts of wind and solar, which is quite a substantial amount. But by 2050, we see the power system undergoing a really radical transformation to the extent that it's going to have to increase sixfold to closer to 300 gigawatts by 2050. About half of this will come from solar, so about 140 gigawatts will be solar capacity, with the rest coming from wind. But it's not just wind and solar. We'll also have to see a lot of batteries coming online in Australia, as well as pumped hydro, to provide storage during the times when the wind doesn't blow and the sun doesn't shine. We're also going to have to see a little bit of capacity come from carbon capture and storage paired fossil fuels. So these would be traditional coal and gas, but paired with mostly gas, but paired with carbon capture and storage to provide backup for renewables. Essentially, what we'll be seeing is a lot of switch in terms of the percentage share of generation. Today, coal and gas forms the backbone for Australian power, accounting for about 60% of generation. By 2050, 91% of generation will come from wind and solar instead. So there's a radical transformation, as I said earlier. Yeah.
Sahaj, so $2.4 trillion of investments needed? I mean, are we seeing that sort of commitment right now? How feasible is this?
Yeah, sure. So to give a bit of background, in our report, we published two scenarios. The first is the economic transition scenario. That's our base case scenario, in which Australia's energy system evolves out to 2050 based primarily on the impact of current policies and least cost technology changes. What we see in that scenario, in our base case, in which Australia does not hit net zero, is that it would require an investment of about $2.2 trillion. That sounds like a lot of money, and it definitely is. The good news is that the premium to get to net zero is about 12%. So $2.4 trillion is only about 12% more than the $2.2 trillion that's needed in the base case scenario. We're going to have to see that money, though, be funneled into technologies that it really helps to drive the decarbonization pathway for Australia in the net zero scenario. So that would be things like investing in electric vehicles instead of internal combustion engine vehicles. Electric vehicles account for about 54% of that $2.4 trillion. In the net zero scenario. We're also going to have to see spending on clean power generation, which I touched on earlier, instead of spending on fossil fuel generation. It's a big sum of money, but we believe that it's feasible because we try to present credible transition pathways in our new energy outlook. And yeah, it presents a significant opportunity for potential investors in Australia's energy transition.
Bloomberg New Energy Finance Senior Associate Sahaj Sood here in Sydney. More ahead on the Asia trade. This is Bloomberg.
We have breaking news out of Japan. We are getting the export numbers, and it's coming slightly below expectations. Year-on-year growth of exports, 10.3% for the month of July, which is slightly below what economists had expected, although it's a much bigger increase than the previous month. Of course, we did have the Japanese yen at around those 160 levels, really multi-decade lows against the U.S. dollar, which potentially boosted imports, but at the same time, that made imports pricier. So year-on-year growth of imports, 16.6% for the month of July, more than economists had expected. Also a jump into the double digits from the previous month. So that leading to a trade deficit of 621.8 billion yen and really returning to a deficit from a surplus the previous month. Again, exports rising less than economists had expected for the month of July, growth of 10.3%. Heidi.
Shery, earnings still in focus here in Australia with the Australian oil and gas producer Santos announcing a 19% decline in first half profits. Softer natural gas prices, higher spending weighing on that overall result. Bloomberg's Paul Allen joins us now for more. So really pressure from both sides.
Yeah, definitely. It wasn't a great half, really. That underlying profit, 654 million. The expectation was for 670 million. Revenue was also down 9% to just over 2.7 billion. Production was down and the price was down. Average price $12.10 per million BTUs. That was down from $13.24 for the same period last year. That said, sales guidance, production guidance for the year has been maintained, and the dividend went up to 13 cents, almost 50% of what it was the same period last year. Santos does have this policy of paying out 40% of free cash flow. There have been a few questions about the sustainability of that. However, this half notwithstanding, the pipeline's looking pretty good.
And what does that growth pipeline look like, given, of course, we know there's some macro headwinds globally?
Yeah, and delays as well. Barossa, one of the projects that's about 300 kilometres north of Darwin, that had been beset by delays, a lot of it due to activist litigation. That's now 77% complete, so we were looking for an update on that, and we got it. We'll still commence production in the third quarter next year. Dorado in Western Australia, another project which is taken a lot of time getting a final investment decision. Santos saying that that's progressing. There'll be a decision on that in 2025. And the Picker Oil project in Alaska, that's still on schedule to deliver its first oil in 2026. So if we take a look at the share price, yeah, it's been dead flat on year, but the average analyst outlook sees another 12% upside, and it's probably got something to do with all these projects finally coming online.
Bloomberg's Paul Allen there. Well, we'll find out a little bit more about the outlook from the Santos Managing Director and CEO Kevin Gallagher joining us live a little bit later. We're waiting of course, a little bit more analysis in terms of what they see down the pipeline and perhaps some views on the weakness that we continue to see out of demand in China and also rising nuclear generation from Japan as well, Shery.
Yeah, take a look at how the Japanese yen is trading. Of course, we just got the export numbers surprising to the downside, but still a double-digit growth, growing more than 10% year on year for the month of July. And remember, the month of July is when the yen touched that 161 level, weakest in decades against the U.S. dollar. We have strengthened significantly since then. For the month of August, of course, we had that spike that led to that unwind in yen carry trades. But at the same time, the yen has continued to strengthen since then. We saw weakness, again, some strength. Still overall, year to date, we're still underperforming major Asian currencies so far this year, around a 4% decline against the U.S. dollar after rebounding from that lowest level since 1986 that we saw in the month of July. A lot to do with what's happening with the dollar slump, lowest since March at the moment. And of course, Haidi, that leading to the other side of the trade with Bloomberg's Asia Dollar Index close to a one-year high.
Shery, take a look at how we're setting up as we head into the start of cash trading in just about 5 minutes' time here in Australia, and other major markets all looking pretty sombre, as you say. It's a rainy day in Seoul and looking pretty grey across the region, right? That US rally deciding to take a breather overnight, and we're seeing that pass through to the likelihood that we'll see declines here in Asia as well. Still, though, Wall Street halted that rally within striking distance of all-time highs, and we have seen that pretty robust recovery in Asia as well. Futures are pointing though to some not insignificant drops in Tokyo, in Sydney, but also in Hong Kong, as well as we saw the US benchmark NG lower to end that 8-day winning streak. But, you know, still so much bullishness that have been in overdrive with these markets over the past few sessions. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens after a down session on Wall Street sent the S&P 500 below 5,600. We could see some pressure across Asian markets. It's a green day here in South Korea as well, Heidi. Raining behind me, as you can see.
Yeah, and really kind of setting up for some caution going into the Bank of Korea decision, right? Remember, out of all of the Asian central bank decisions, we're not expecting anything other than pauses from the BOK, the BOT, as well as Bank Indonesia. And still, of course, Shery, a lot of focus on what we hear from the Jackson Hole Economic Symposium. There is still a fair degree of caution in these markets if you take a look at what's going on with the dollar, with gold, for example, and I suppose that fear of a revival in yen-driven volatility.
Bank of Japan Governor Kazuo Ueda not attending Jackson Hole. He needs to speak in Parliament for a special session. But take a look at how the Nikkei is coming online, because we are seeing downside after those gains in the previous session. We just had export numbers out of Japan showing that exports gained more than 10% year on year for the month of July. Remember, that's when the Japanese yen was around that 160 level. We have strengthened significantly since then, but we're still underperforming when it comes to broader Asian currencies. Of course, we are seeing that upside for Asian currencies with dollar weakness. We're at the lowest level since around March. Take a look at how the Kospi is coming online. The Korean won has been on a tear, gaining ground for 5 consecutive sessions. We are getting the export numbers for South Korea for the first 20 days, rising 18.5% year on year. Really a lot to do with those semiconductor exports. We're also seeing that for the first 20 days, imports rose 10.1% year on year. So big import number, leading to a trade deficit as well of more than $1.47 billion. But really, the Kospi under pressure in today's session after rising to the highest level since the beginning of the month, given, of course, those chip exports and financial stocks leading those gains, Heidi.
Yeah, and of course we continue to sort of really gauge the implications of other markets, including China, given how much of that sort of is an early indication of global trade demand and health, really. Take a look at how we're setting up as we get into just that cautious, staggered start to trading here in Australia. This is the ASX in the first sort of few minutes or so of trading, looking pretty flat at the moment. Of course, it has been sort of still a big day for energy earnings in particular. We had numbers out of Santos. Clearly, some of those elements to the business are quite a bit of pressure coming down from really both sides, from demand as well as costs as well. We're also watching Insurance Australia as well as Brambles in terms of those numbers. The Aussie dollar actually on the front foot at the moment, 67.48. We had some of the sort of weakness from the US dollar, I should say, really passing through to some potential strength across Asian currencies today. And of course, when it comes to treasuries, we really are just watching in terms of both the jobs numbers that are expected to see quite a significant revision, as well as commentary from the various speakers at Jackson Hole. That Treasury yield curve, though, is broadly shifting lower. We're also watching some of the action on the energy front, with oil holding on to those losses. More really signals of that continued stockpile build in the US. Let's bring our next guest, who favours growth stocks, quality growth stocks, that is, including benchmark heavyweights in Asia. With us now is Kelvin Tay, who's a regional CIO at UBS Global Wealth Management. So there is a brittleness, it feels like, even with the overwhelming bullishness that we've seen in this, post-sell-off recovery, Kelvin. Are you in the more cautious camp in that you're looking still for elements of safety within what seems to be, as a headline, a broad return to risk?
Yeah, I think the main risk for me personally is basically where the Japanese yen is. If the Japanese yen stabilizes at the current levels, then I think, we can actually expect the risk levels to actually go up again. But if the Japanese yen continues to strengthen and goes beyond the 140 level, then I think what's going to happen in the last couple of weeks could perhaps actually rear its ugly head again. Because the Japanese yen is where the Japanese yen has been used as a funding currency of sorts for all sorts of trades globally. And therefore, a strengthening yen is likely to actually lead to a lot of risk aversion in that sense.
This is sort of the question that we've been asking, right? Could we potentially see, even further running when it comes to dollar-yen downside? And I guess, how much strength can you afford to see in the yen before we see another bout of volatility?
Yeah, I think it hinges on two items here. Firstly, the potential rate cuts by the Federal Reserve in September. A 50 bips rate cut could potentially actually move the dollar-yen further. And secondly, with now the political uncertainty as well, we do expect elections to actually come in Japan. If you go by the tradition of, appointing a new leader of the LDP, etc., we do expect elections to actually come in the month of October or November. And that in turn might actually shift the fiscal policy of the Japanese government. Because don't forget that, the current Prime Minister has actually been affected not just by the slush fund scandal, but also by the fact that the yen has been particularly weak and inflation has actually been pretty strong in Japan itself. So I think the new incoming Prime Minister, whoever he is, will actually be very, very cognizant of the fact that, you can't have the yen too weak. And that in turn might actually lead to a shift where the policy of the Japanese yen is concerned.
The weak yen definitely has helped Japanese exports. In fact, weaker Asian currencies like the Korean won also helping those exports. We got the first 20 days of trade for South Korea as well. Really a huge jump. Does that give more momentum to some of those tech names, especially semiconductors? Of course, these big tech heavyweights like Samsung, SK Hynix from now on.
Yeah, I think it does to a certain extent. But don't forget that this year, on a year-to-date basis, global trade volumes have actually picked up quite nicely. And that, in turn, is basically a very important tailwind for a lot of the Asian exporters. But I think one of the main reasons why the Asian currencies in particular, have been appreciating is because of the fact that the gap between the US yields and the Asian currency yields have actually narrowed quite significantly. At the start of the year, we were looking at 4.2 to 4.4% where the 10-year US Treasury yields are concerned. Now it's come back down to about 3.8%. And I think with the rate cuts coming coming in September, that might actually trend lower as well. And that's what the currency markets are actually starting to price in. And of course, we all know that with a weaker dollar and stronger Asian currencies, that in turn tends to actually be very good for Asian equity assets or Asian bond assets because of the fact that the inverse correlation between the Asian dollar index and the Asian asset markets have always been very, very strong.
How do geopolitical risks really play into the Asian markets? We have the Democratic National Convention ongoing right now. We are headed towards the U.S. election. We were just talking about the LDP election in September as well.
Yeah, I mean, geopolitics has been a bit of a factor in the last couple of years. And I think with the upcoming U.S. elections, the rhetoric and the saber rattling will get louder and louder coming out from the U.S. In particular, let's say, for example, if the Republicans were to actually come back into power, then obviously the potential 10% tariff that they're talking about implementing on all exporters going into the US, that message will probably resonate a lot louder, a lot stronger with the markets. So at this point in time, I think it would be, prudent to actually probably not be too exposed to a lot of the Asian exporters, given the fact that the US election is just around the corner. But we do think that there's quite a lot of value with regards to the Asian benchmark heavyweights because of the fact that, Asian equity markets are still very undervalued compared to the US equity markets. And again, with a weakening dollar, we do think that the trade is now pretty much in favor of the Asian benchmark heavyweights in that sense. So I would actually expect the Asian equity markets to actually do better over the next 3 to 4 months. Notwithstanding the fact that you have the big elephant in the room, the US elections just around the corner as well.
The other elephant in the room, of course, is the continued slowdown in China and the question marks over whether authorities, intend to or in fact can, reverse the structural slowdown, right? How much risk do you think derives from the expectations of a balance sheet recession? And is it sort of surprising that, in a sense, that Chinese assets are quite decorrelated when it comes to the optimism they're seeing around the rest of the region?
Not a surprise there. I think there are two aspects to the Chinese economy. The cyclical aspect and the structural aspect. Where the cyclical aspect is concerned, we've sort of detected a very gradual improvement. And largely, again, that's because of the fact that your global trade volumes have actually improved and, China being one of the major exporters in the world, that's actually benefiting from that. And on top of that, we've also noticed slowdown in the unemployment figures. Unemployment has actually been getting a little bit better over the last month or so as well. But it is the structural aspect of the property market that is actually really pulling things back. And for us, that part is actually relatively easy to actually analyze because of the fact that, you really just need to look at the weekly sales numbers of the private developers in China. If you see any improvement in the figures there, then obviously that's likely to point to an improvement in the property sector. But if you see the numbers continuing to deteriorate, then obviously that means that the property market continues to pull the general economy down. Given the fact that consumption is pretty much centered on small ticket items at this point in time, and not really on the white goods, which is what is actually needed to pull the economy back up. So we do think that the improvement of the property sector is actually key. But at this point in time, despite all the rhetoric and all the policy statements that have actually been coming out, we've not seen very much being executed on the ground. And that's what's holding back the market.
Kelvin, always great to chat with you. Kelvin Tate, Regional CIO at UBS Global Wealth Management. We are watching Tesla suppliers very closely in the day's session. Of course, we had that story about the EU planning that 9% tariff when it comes to Tesla cars that are made in China ahead of the China EV probe. Of course, really seeing an advancement there. The bloc saying that consultations are continuing ahead of the October 30th deadline. China has threatened to retaliate against EU penalties, so we'll wait to see if we get a response from Beijing. But it has notified automakers of the draft decision to move forward with definitive tariffs on EVs that are shipped from China. So we are seeing actually largely positive trading when it comes to some of these Tesla suppliers. Panasonic is really the laggard. They're down by just shy of about 1%. The other story that we're watching, of course, is Santos when it comes to the Aussie gas majors' first half underlying profit down 18% from the year before, really struggling on a number of fronts, including declining production as well as lower energy prices. This is Australia's second largest oil and gas exporter, underlying profit of $54 million in the 6 months to June 30th. That missed analyst expectations. We saw LNG spot imports in particular to key markets across Asia have seen that steady decline, and there are ongoing concerns when it comes to the waning demand out of the Chinese economy, as well as Japanese nuclear capacity coming back online there as well. But there are sort of a little bit more good news when it comes to the pipeline for production, with major projects looking a little bit more positive, but still downside of almost 3% just in the first 10 minutes of trading here in Australia. More ahead on the Asia trade. This is Bloomberg.
This week, Balance of Power is live in Chicago for the Democratic National Convention.
So we've got a race here, and the sprint begins.
We'll bring you breaking developments.
Vice President Kamala Harris closing the gap with Donald Trump.
And informative analysis, all leading up to special coverage Thursday evening, including Vice President Harris's acceptance speech as the Democratic nominee for president.
As president, I will show Donald Trump what real leadership looks like.
Tune in all week on Bloomberg Television.
The European Union says it plans to introduce an additional 9% tariff on Teslas imported from China. It's the next step in the bloc's moves against Chinese-made EVs, which it claims unfairly benefit from state subsidies. China correspondent Mingmin Lo joins us now from Hong Kong. So how much will this hurt Tesla?
Yeah, it will have quite a big impact because China is a very important production base for Tesla. It has the Gigafactory in Shanghai, which is a humongous one that is bigger than its other factories combined. It produces more than half of its EVs from China alone. So this 9% tariff will hit its profit margins already. We're seeing Tesla hiking the prices of its Model 3 that was sold in Europe starting from last month by about 1,500 euros, citing the additional tariff burden. The good news, though, is that EU officials have lowered their tariff rate to just 9%, which is less than half of the average tariffs that other producers face, and it's less than 4 times the maximum of 36.3% that SAIC has to pay. There you go. Take a look at the chart there. It produced over 500,000 cars from China year to date so far. That's already exceeded the entire year production in 2021. The EU officials said that they are getting lower tariffs because they benefit less from subsidies from Beijing, but they still enjoy some unfair advantages, including all sorts of different grants, access to batteries that are below market price, land use rights, reduction in income tax, for instance, as well as that national subsidy that is applied to all exporting producers. Yes, it would have an impact, but less than other producers, so that gives Tesla a competitive advantage there.
What sort of response could we see from Beijing?
Yeah, so this tariff right now is still a provisional one. It's issued as a guarantee, and it will only be collected in November when the final tariffs will kick in. So EU officials have said that the rate could still be subject to change. So there's still some room for negotiation there. We could expect some wrangling, maybe some dangling of carrots and sticks from Beijing in the next few months. So far, Beijing has already expressed their opposition to this move, saying that it's a protectionist move from the EU. They have opened up anti-dumping probes into areas like pork and European brandy as well. They have threatened retaliation in other areas like agricultural goods, aviation, and even vehicles with large engines. That would affect companies like BMW, Mercedes. These are companies that count China as their biggest market. So China does have some firepower there to unleash if they want to. And meanwhile, Chinese producers are already taking contingency plans by looking at ways to set up plants in European countries in order to bypass these tariffs.
Bloomberg's China correspondent Min Lo there with the latest. And as the EU advances its investigation into China-made EVs, we're also waiting for key earnings across the sector. Our tech reporter Annabelle Jewellers has the latest. So Geely, one of the names that is at risk of extra tariffs. What are we watching today?
Yeah, that's right. The risk of higher duties is perhaps one of the risks to the outlook for the company. Today, when we do get those numbers being reported, one of the things that we're going to be watching or listening out for is whether we get any comments from the subsidiary Zeekr and whether it's looking to build EVs in the EU to try and avoid tariffs there. Ultimately, though, it has shaped up to be a pretty strong first half for Geely. Our Bloomberg intelligence team is saying that we likely saw a jump in earnings that will have meant more shipments, more exports, a better product mix. What is sort of one of the key risks to the outlook, though, that they're flagging or highlighting is that ongoing price war and that intense competition in China, because we know that we've seen not only a lot of new entrants coming into the space, you've seen waves of price cuts as well to try and tempt more buyers, given you've got that slowing auto market just generally.
Yeah, that price war really having an impact on XPeng as well. What else we learned from its earnings?
Yeah, so we had earnings out overnight for XPeng, and certainly not great numbers, or not what Wall Street was expecting to see. We did actually have a net loss again in the second quarter that was narrower than expected. But what really caught investors' attention here, you're taking a look at those losses that they reported, not only for net income, but then also earnings losses per share. But still, what really caught analysts' attention here was what they forecast. So deliveries for the current quarter, they're actually going to come in higher than what Wall Street or what analysts had been expecting, but projected revenue from that was well below predictions. And so that tells us that the car maker is making not as much money per car as had been hoped. And so again, that speaks to not only the weaker macro environment in China, but also those new models and those new entrants that are coming into the space.
What about Xiaomi? Obviously, we largely know them as smartphone makers or maybe home device makers, but they've been pretty high profile in their EV ambitions too.
Yeah, so we saw it releasing or launching its new lineup in April, those SU7 EVs. And actually, the introduction of these EVs into the space could have been something that helped Xiaomi in this latest period. So we're expecting the fastest pace of revenue growth in 3 years. So we could see around a 30% jump in revenue in June, or rather for the June quarter. So around 87 billion yuan. Of that 87 billion, around 46 billion is still going to come from the smartphone segment. We did start to see a global smartphone market bounce back in this period as well. But again, there is that EV portion to the sales. So just with the introduction of those EVs, we could have seen, according to our Bloomberg intelligence team, we could have seen around 6 billion yuan of revenue being generated in the second quarter. Although it is worth pointing as well out that the EV gross margin was still probably negative in this period, and that is something that could have impacted the overall margin for the company, Shery.
Annabelle Jewelers there in Hong Kong, a busy week when it comes to earnings in China. We do have more ahead on the Asia trade as we continue to watch Santos as well. The Australian gas giant continues to fall. This, of course, after it saw its first half underlying profit declining 18% from the year before. This is Bloomberg. Former U.S. President Barack Obama will take center stage on the second day of the Democratic National Convention in Chicago. Presidential nominee Kamala Harris is already leaning heavily on his former staff and strategy in her bid for the White House. Bloomberg's Jonathan Tamari joins us now from Chicago. Jonathan, so what are we expecting today, and what are we seeing in terms of the strategy that Harris is implementing here with the staff of former President Obama?
Yeah, so what we're going to see tonight is really the passing of a torch from one historic figure to potentially another. Obama, obviously the first black president, handing off to women who could be the first black woman president, first Asian president. And there's a lot of things that link their stories between having coming from mixed-race parents. They've been supporters of each other for a long time. And as you note, now many former Obama aides are working for Vice President Harris. And you're seeing a really different kind of tone and campaign than President Biden was running, even though she has also retained much of his staff. It's much more geared towards younger voters, much more geared towards social media and memes and kind of capturing the cultural moment right now with superstars and links to cultural references. And so you're kind of seeing a more energized and youth-focused campaign, I think, than we were even a couple months ago.
And there's a real hope that this sort of assembling of a broad coalition could be replicated, right, as we saw certainly with President Obama's first campaign attempt. How quickly do they have to work here? Because we know that there's typically a bump after the convention. We know that the polls have really been narrowing. But is there a risk that momentum could be lost?
Well, I think after this week that we'll probably see this surge that Kamala Harris has been on probably reach another peak. And if history holds, it'll probably come back down from there and tighten up a little bit, because these post-convention bumps happen, but they don't usually last. We'll get into September. She has not been seriously vetted by Republicans yet, because she's only been the nominee for a relatively short time. And so there will be a lot that will come at her once we get into September here. And that will be the challenge, to say, okay, now that we've had this initial surge, this initial kind of energy that's come out from having the change, can she withstand that, or can she continue that? Can she keep it going in the face of the attacks that are coming? I think that the campaign, if history holds, will get tight again, and will be tight throughout until November.
Our U.S. Congress reporter Jonathan Tamari there in Chicago as we continue to watch the Democratic Convention throughout the course of this week. Other top stories, though, we're following today. Hamas says it's keen on reaching a ceasefire agreement with Israel, pushing back on U.S. claims that the militant group is stalling negotiations. Earlier, U.S. Secretary of State Antony Blinken said Israel had accepted a bridging proposal, and the next step was for Hamas to agree. A new round of negotiations is slated for Cairo this week. No date, though, has been set.
Our message is simple, it's clear, and it's urgent. We need to get the ceasefire and hostage agreement over the finish line, and we need to do it now. Time is of the essence.
Asian countries are beefing up surveillance for the Mpox virus, with travellers from affected countries being asked to self-report symptoms. That's after the World Health Organization called it a global health emergency. The so-called 1B strain has reportedly killed more than 500 people, mostly children, in the Democratic Republic of Congo. The Italian Coast Guard says it's unlikely to find any more survivors from the sinking of a luxury yacht off Sicily. It means British tech tycoon Mike Lynch, Morgan Stanley International Chairman Jonathan Bloomer, and 4 others are presumed dead. The yacht was hit by a violent storm early on Monday, with Lynch, his family and associates on board. They'd been celebrating his acquittal in a long-running fraud case. More ahead on the Asia Trade, this is Bloomberg.
Take a look at how currencies are trading, because we have seen, of course, the dollar slump to that March low. On the other side of the trade, Bloomberg dollar Asia currency is now at the highest in almost a year. And in fact, some of the biggest leaders are there. Indonesian rupiah, Malaysian ringgit. Also, the Thai baht has been up. Of course, Indonesia's rupiah are rising in the previous session ahead of that expected decision from Bank in Indonesia. They held steady. We are still expecting Thailand's central bank to hold as well. Joining us now in Hong Kong is Trin Nguyen, emerging markets Asia economist at Natixis. Trin, great to have you with us. We're seeing a little bit of a holding pattern across Asia when it comes to broader central banks.
Absolutely. We had New Zealand and the Philippines cutting, but I don't think Indonesia and Thailand are going to follow just yet. They will certainly cut, but they don't really need to at the moment. For Thailand, growth is rebounding, and even though in August both of these currencies have done pretty well, as the dollar is in the driver's seat, it's really expectations of the markets for Fed to cut. It's quite large for 2024 and 2025, and as a result, bond investors have piled back into EM Asia, particularly ASEAN currencies. And so we have a significant appreciation. But year to date, these currencies are still not strong versus the dollar. And so for them, there's still a bit of fear of inflation and so on and so forth. And as a result, we don't expect these central banks to cut just yet. They will hold for now. And I think the key drivers beyond the dollar for these currencies in terms of divergence in performance will be idiosyncratic risk within these countries, right? In Thailand, for example, we have a new prime minister. The previous prime minister put a lot of pressure on the BOT to cut, and the BOT has so far held off. The question is what's going to happen next in Thailand? Certainly, the $14 billion cash handout is a big question. That's almost 3% of GDP. And so there's a little bit of uncertainty. So for the BOT, it's going to hold on and see how everything unfolds, particularly with growth risk.
Also a hold expected from the Bank of Korea this week, right? I mean, we have seen a little bit of strength for the Korean won, but this after significant weakness. How is the BOK thinking about currencies right now?
Everything is a bit balanced for the BOK. As you know, it has a cyclical recovery from the ICT sector. This morning, we saw a very strong bounce of exports driven by semiconductor rising very rapidly. It's been a trend for the whole year, and that has boosted growth upward for South Korea, right? So there's upward revision all year long of growth because of exports. Now, on the other hand, despite of holding rates at 3.5%, the housing market has been very supported. The BOK wants to delever household debt. Household debt started deleveraging early in the year, but started rising again due to the pickup of mortgage debt. Now, I think that's a bit of a concern for the BOK because it hasn't cut just yet, and it really wants to deliver to a certain level that's a bit more comfortable. Household debt in South Korea is a bit too high for comfort. So for the BOK, between the three central banks we're talking about holding here, we think that the odds of the BOK holding for much longer is much higher than, say, the BOT or Bank of Indonesia.
Yeah, Bank of Indonesia is an interesting one, right? Because obviously we're at this sort of cusp of the leadership transition, but at the same time, we just had the reshuffle, and clearly there's still going to be a lot of Jokowi influence within the new administration. Do you think the political risk fades? Because, as you say, this isn't sort of another case that's sort of adjacent to Modi in India.
Well, this is certainly not 3.0, Modi 3.0. We have Prabowo taking over rather soon. And I think investors were quite calm by the fact that the budget didn't exceed the 3% constitution limit. It did lower infrastructure spending, and it did raise a lot of this education and free food as Prabowo had promised. And the most importantly is that very likely we'll have very similar finance minister. Now, there's no certainty because he is a different leader. He's a new leader. He didn't win the election just to take directions from Jokowi. So we'll have to wait and see how that develops. Meaning, for the short term, we have the Fed with markets at rate cuts of quite large, driving the rupiah higher, right? Because it's rather high yielding, and moreover, in the short term, at least they're sweet talking the market. So concerns regarding fiscal slippage, it has been assuaged, but it doesn't mean that it's completely disappeared. So I would say between Malaysia, which has a much more stable government, Thailand and Indonesia, I would rank Malaysia much better in terms of political risk. Indonesia, and at the lowest spectrum is Thailand, where we have great uncertainty. We still have another decision coming up regarding Thaksin. And so while there's a bit of calm because of the Fed in the driver's seat, I think risks for Thailand have not gone away. And this is one of the reasons why I think the BOT will be vigilant and hold out and save bullets. And should they need to, they can always cut later.
It's been a long debate as to whether China is also facing down a balance sheet recession the way that Japan did so many years ago, right? Do you think this meaningfully adds to the risks? Because it seems like the relevance of China, even within the emerging Asia space, is becoming less and less correlated.
Well, China is still important in the regional value chain, right? So this year, even though China, in terms of growth, has been very disappointing, you saw the number, investment was very weak. So in terms of its imports for its own demand is weaker, and even its boost for tourism is weaker for the rest of the region. You still have its importing for regional supply chains. Now, the reason why China is becoming less important is much more pronounced when we think about what's happening in the U.S., right? Fears of recession in the U.S. really push global markets downward now. The fact that it has been fading has really assuaged Asians, particularly ASEAN economies that are very tradable, is the fact that not only will we get financial conditions easing, we hopefully will get also still decent demand from the U.S. Now, if we don't have decent demand from the U.S. and the outlook for China rather weak, then that's one of the key risk market, right? Are we going to really have this Goldilocks scenario where the U.S. continue to be a key demand of the market and that the Fed somehow would still significantly cut in 2024. So I do think that there's a bit of risk for EM Asia in the short term if markets reprice, particularly after Jackson Hole and the minutes come out. But at the moment, the U.S. dollar is in the driver's seat for that particular reason. The fact is that we don't see significant stimulus in China. Much of the stimulus is really to smooth the bump downward rather than really significantly inflate its own economy, let alone the rest of the region.
Trend in emerging markets, Asia economist at Natixis, as Trend just said, it really is the dollar in the driving seat, right? Take a look at what we're watching when it comes to the Chinese yuan, the 3-day moves. And of course, we've had sort of that rebound, pretty solid rebound off the 8-month low against the US dollar, but snapping those 2 days of gain. So we'll be watching very closely because we have heard from one prominent economist in China saying that the yuan could soar as the carry trade unwinds, that exporters could convert their hoarded dollars into the Chinese currency, and that shift in market sentiment does risk triggering a steep appreciation. So it could see a similar scenario to the unwinding of the yen carry trade potentially playing out there. This is according to Guan Tao, who's a global chief economist at Bank of China International. If people see a signal that the yuan could strengthen by 3 to 4%, they won't be interested in holding the dollar and profiting from that yield gap. We also know that Chinese regulators, the FX regulator at least, has been asking banks to survey the impact of a stronger yuan, depending on the developments in FX conditions. We have seen the Chinese currency really making up that bulk of the year's weakness in the month of August so far. Staying with China, of course, we've been reporting the EU is advancing its plans to tackle what it sees as unfair EV subsidies in China with higher tariffs. It's part of course, a broader Western war and alleged Chinese industrial overcapacity. Bloomberg opinion columnist Shery Ren says China is suffering too as it overproduces steel, batteries and solar modules. She joins us now in Hong Kong. So Shery, China suffered a big bout of overcapacity between 2012 and 2016. This is a country that, you know, when sort of one commodity or asset or product is hot, we almost always see overcapacity, right? Is there a solution? Was there a solution back then?
Yes, actually, President Xi Jinping had a pretty good solution. He called it a supply-side structural reform. Basically, it was trying to rein in supply. And back then, less than 10 years ago, actually, it was steel, coal, and to a lesser extent, aluminum that was causing trouble. And back then, the European Union and the U.S., they were also very concerned about China's flood of cheap steel supplies into the global market. And so what China did was like they basically forced a lot of steel and coal factories to close. China, within 2 years, basically cut down supply by 10-15%. And they actually spent 100 billion yuan to help pay for coal and steel workers' relocation and severance. And that actually worked pretty well. Within 2 years, the oversupply problem started to diminish. And then some big companies, the bigger state-owned companies, actually became profitable. So that was a solution that worked less than 10 years ago.
And why not do that now? Would that sort of supply side reform work as well?
I don't think so, because this time the kind of problems that are worrying European Union and the US are different. We're talking about solar modules, lithium batteries, and electric vehicles. And these new economy sectors, they are unlike steel and coal. They're not state-owned at all. I mean, we know the biggest players, BYD, Cattle, they're all private enterprises. The President Xi basically cannot tell them to shut down their supply, close factories. They can't. And also the biggest players, they kind of like this kind of oversupply situation because so far they are still profitable. And this flood of oversupplies will force the smaller, weaker ones to exit the market early.
Why is China so uniquely prone, I guess, is the argument, to industrial overcapacity, to market asset bubbles?
It's a really good question. I think some of it is just China has a lot of animal spirit. If you see a good field, everyone will crowding. But another part, I think it's just like all these new industries, they just sprang up so quickly, right? Like we see housing, we see new electric vehicles. Just within 1 or 2 years, they suddenly came up and became hot. And a lot of entrepreneurs, they don't really know what the total addressable market is. They think like sky is the limit, so everyone comes in. I think it's just China is growing too fast. And all these industries just come up too early and too fast.
Bloomberg opinion columnist Shery ran there with the latest on the Chinese economy. And in fact, we could actually see big losses when the Chinese markets open. We saw those losses on China U.S. listed ETFs overnight. We had some sessions earlier in the week as well, where we had Hong Kong stocks falling on Tuesday, for example. When the rest of APAC rallied, then you can see right there is a sea of red already, with the Nikkei falling almost 1% and the Kospi also down 0.2%. We have more ahead on the Asia trade. This is Bloomberg. The world's biggest shipping centers are getting caught in the crossfire of intensifying geopolitical conflict. Today's Bloomberg Big Take looks at how ports have turned into strategic battlefields as global powers use them to defend their economic interests. Senior economy and government reporter James Mager joins us now from Beijing. And James, of course, we know that ports are so critical when it comes to global trade. What are we seeing now, given that we're seeing so many geopolitical tensions flare up around the world?
The first thing I think that we should think about is that, as you said, ports are really important. But for a long time, I guess that's sort of been out of sight and out of mind. Ports are sort of on the outskirts of many cities, and people don't really think about where all the goods that they're buying come from. And then during the pandemic, you saw massive queues at ports in America because their infrastructure there just really wasn't capable of dealing with the huge expansion of goods trade that we saw because of the pandemic. And so suddenly it became a really sort of hot topic. People were very interested in making sure that the ports infrastructure they have is capable of dealing with the trade that we're already dealing, and also is capable of dealing with the trade in the future. And then a second thing that came into sort of focus was who actually controls all of these ports around the world. And it's been a sort of a rising topic over the last few years, but it turns out that Chinese companies are actually, 7 of the 10 world's most important ports are actually in China, and then Chinese companies have been going out around the world and buying up port infrastructure. Places like Darwin in Australia, this new port in Peru, Piraeus port in Greece. They're trying to take it, various ports in Europe either have Chinese ownership or Chinese stakes, and so there is the geopolitical sort of tensions we're seeing between the US and China and other countries is now playing out into these sort of critical transport nodes that we see around the world. And the second question that that we need to start thinking about, people are really thinking about now seriously, is how do we deal with with climate change? Ports and shipping is an incredibly dirty business, and there has been some improvement on the fuels that are used to power the ships that take goods across the oceans. But these ports are having to deal with not only rising sea levels and questions like that, but also how do they power the machinery that actually moves things around the ports. So you're seeing a lot of efforts to use EVs and automated machinery, which is more environmentally friendly, to actually do things in ports. So for example, Singapore Port is moving towards a totally automated, totally EV-based model over the next 20 years. Obviously, it's a huge investment in time and money, but these are the sort of things we're seeing.
What are the sort of major changes you're seeing when it comes to the broad trends of upgrading port infrastructure?
The first thing I think you're seeing, and it's really creating a reaction mostly in America, as I said, is automation. The Singapore port is going to be fully automated. Qingdao port in China and other ports in China are already moving towards more and more automation in their ports. And that's actually sparking a reaction on the geopolitical front, because a lot of those automated machines like cranes and the trucks that move the containers around ports are made in China, and they're now increasingly in the US. Anything that's made in China is being seen as some kind of security threat. So there's an effort to improve that automation, but at the same time, so much of that is dependent on China, it's sparking a reaction in places like the US. And I think the other thing is the expansion of global trade and the expansion of ports to places that we don't normally think about in the West. As I mentioned, the port in Peru, there are other ports around the world that are being rapidly expanded because global trade patterns are changing. The blockages in the Red Sea is causing more and more ships to go back around the Cape of Good Hope, which is sort of somewhat reversing the trend of the last 150 years since the Suez Canal was opened, where ships would go through the Suez Canal to save time. More and more countries are building bigger ports. India, for example, is building its largest port right now as part of their effort to try and scale the global value chain. You need to have ports to be able to ship goods, to be able to buy goods cheaply from the rest of the world.
Our senior economy and government reporter James Maker there in Beijing. Subscribers can read more on today's Big Take on the terminal. It's at NI Big Take is your function on the terminal. You can also find that at Bloomberg.com. More ahead on the Asia Trade. This is Bloomberg.
Take a look at how we're trading across Japan right now, because we're seeing downside of 0.6% as we see the Japanese yen holding at around that 145 level. Of course, we have had strengthening of the Japanese yen throughout the week against the U.S. dollar. The U.S. dollar still holding at near those lows that we saw in March. The Japanese stock market, though, has rebounded strongly from those losses earlier in the month. In fact, when the Japanese stock market endured its worst sell-off in years earlier in August, foreign investors were selling futures heavily, but also buying cash equity. Some see this as a good sign of confidence from stickier money. Senior Asia stock reporter Hideyuki Sano joins us now from Tokyo. Hide, is there more trust and belief on the fundamentals of Japanese markets? What does this dynamic tell us about how long this rally can last?
Hi, Shery. So as we all know, we had a very crazy week at the beginning of August. So everyone was very interested in what was going on. And we had the data from the Tokyo Exchange basically showing that foreign investors were selling futures. They were buying cash equities for the first time in 4 weeks. So that seems to be telling us that at least some longer-term investors are quite content with buying Japanese stocks on dips. And as for futures, mostly they have been driven by short-term players like macro hedge funds or event-driven types. And we can see evidence of that if you look at the more closely to the futures data. We got Nikkei futures and Topix futures, and there's slight difference there between those two. Nikkei futures are preferred by speculative accounts because they tend to be much more volatile. And if you look at data, the selling in the Nikkei futures were much bigger. I mean, it was the largest since the Silicon Valley Bank's collapse last year. And on the other hand, well, selling in Topix futures was big, but it was nothing sort of record-breaking. So that also adds to the evidence that it was really short-term players that had basically driven the market's route, and possibly a rebound after that.
Haidi, how much concern is there at the moment that we could see another revival of yen volatility? And I suppose the question is really, how much momentum is there behind yen appreciation, and to what point we get to another unwinding?
Yeah, I mean, that's a real question. I mean, the yen has been obviously one of the key focuses at the moment, and there are people who are concerned or who think that the yen might strengthen further, possibly below 140 in the medium term. So for those people, I think it is probably not the best time to buy Japanese stocks at the moment. But on the other hand, I mean, there's been so much discussion about the unwinding of yen carry trades, and nobody really knows the exact size of it. But if you look at these positioning in stock futures, again, I mean, it's not like we have a complete data, but I mean, according to a Nomura analyst, they estimate that short-term players still have about 1 trillion yen of net short positions in Japanese equities. So that at least points to the possibility of a bit more buying in the near term.
Senior Asia stock reporter Haidi Kasano there in Tokyo. We could see some sustained weakness as we get into the start of trading in Greater China in particular. Take a look at really the risk of some pretty steep drops when it comes to Hong Kong stocks, in particular looking vulnerable Hong Kong traded tech stocks as well. The Golden Dragon Index dropping the most in 4 months. We also saw sharp declines when it comes to China US listed ETFs as well, so potentially adding to the losses in Hong Kong today. This is Bloomberg.